So let's switch over to some Fed data here from the Fred data from the Fed. And I want to take a look at a couple things. So first, let's start here with the 10-year Treasury. This is the constant maturity minus 2-year Treasury constant maturity. So this is the 10-year Treasury yield minus the 2-year Treasury yield. Why is that important? Well, let's break it down here. So essentially what we have here is whenever we see these gray highlighted outlined areas in the backdrop, that is a recession. Okay, so this piece of data is extremely important because when the 10 and the 2-year flip, that's the yield curve inversion and how we measure that. And essentially what that's doing is it's a very, very good predictor of recessions. So we'll see here, obviously, this was back in, I have these charts so they line up. We'll look at the bottom one in a minute. This is 1978. We go below the zero line. So we flip below the zero line. So we had yield curve inversion take place in 1978. And then we actually had a recession in 1980. And then again, we just spent a bunch of time below this, actually the most time ever. And then again, we had a recession in 81. And then again, you know, obviously it goes back to normal. And then again, we start to see it falling again. And then once again, we go below the zero mark in 1988. And then what do we see? A recession in 1990. So we see this as a predictor, you know, roughly around like 2 years ahead of time of when we see a recession. Here we dip below the zero line. We get like a dead cat bounce. We come back below it again in roughly 2000. Obviously, that was a key time in U.S. history. And then, of course, recession, you know, in 2001. And then once again, we see the same thing take place again in 2006. We dip down below it, bounce back up off it, come back down. And then, of course, like within a year to 2 years, we see the recession of 2008 as well. So this is a very, very good indicator. And then, of course, you know, this is most indicators or oscillators that people use are lagging indicators. This is the opposite. A lagging indicator obviously telling us what's happened after it's already happened. You know, things like moving averages, you know, etc. Those are lagging indicators because they're telling us what's already happened. They're not telling us what's going to likely happen in the future. This is a leading indicator because it's predictive in nature. It tells us ahead of time what is likely going to happen. So here we see when it dipped down, and again, there was a bunch of different things I was pointing out why I was expecting a market crash and, you know, basically a recession. And here we see in 2019, you know, September, we dipped down into that level. And then in 2020, obviously, we actually confirm a recession. Okay, so obviously we come out of it like instantly. We see normally these recessions last much longer. You know, your average recession being something like this, where you can see the areas highlighted gray in the background. This was basically just a dab of a recession, and then, you know, a ridiculous amount of stimulus, obviously, Fed and, you know, monetary and fiscal policy got us out of that and quick. But now what do we see happening again? Well, we see this is obviously very clearly peaked, and now we're starting to roll back over. Now, is it too early to say that this is going to invert again? Well, it is. It's too early to tell for now. But every time we see aggressive peaks like this, we see continuation back to the downside. So obviously, we see an aggressive peak, it sells back off. Aggressive peak, sells back off. You know, aggressive peak, it comes almost all the way back down. Aggressive peak, you know, and you get the point. When we see those aggressive peaks, it tells us that we've probably reached the top. Now, it is possible we get a situation like this where we see continuation before it peaks, but more likely than not, what this tells us is, you know, and the more data we have going out 1, 3, 6, 9 months from now, you know, we'll have a much more accurate idea as to what's taking place. But, you know, essentially this yield curve inversion or flattening of the yield curve for now is telling us that we are very likely to see another recession right around the corner. And by around the corner, I mean in the next 3, 6, 9, 12, maybe 24 months even. You know, but in the grand scale of things, you know, in a 10-year, 20-year, 50-year time horizon, you know, 6 months or 2 years is a very short time. So, you know, obviously we would expect people to front run this and position ahead of time. So this tells us what's going on with the bond market and how it relates to the Fed funds rate. So now let's take a look at this chart here. So this one is the, once again, you know, Fred data. This is the Fed funds effective rate. So this is basically, you know, the short end of the curve, Fed's well, I mean, it's supposed to be determined by the market, but essentially it's determined by the Federal Reserve by, how much they're buying and not buying, or buying and selling inside of the short-term bond market. So obviously they set the Fed. So well, let's take a look at this. So obviously, again, I have them lined up time-wise, but we can see how the recessions line up with what the Fed is doing on the Fed funds rate. Okay, so here we have a strong peak. This is again going into like 1980. Let me scroll down just a little. There we go. This is going into like 1980. This was 17.6% interest rate. And then obviously that was recession. And then here again, we see in 1981, Volcker reaches 18.52% interest rate. I mean, these numbers are ridiculous. Can you even imagine, putting money away and getting 15 or 20% annually on it? No, it's ridiculous to even think about that at this point in time. I mean, you'd be lucky to get anything. I mean, it's absolutely unbelievable. But again, this is not real rates. So at the time, they had massive amounts of inflation. And so they raised this rate to make the cost of borrowing money extremely expensive, therefore to curb the inflation, because obviously the inflation was the result of rampant speculation because money was so cheap for so long. So now we see, obviously, this started to fall off, obviously coming out of the recession here. And then once again, they start hiking rates right here in 84 and then have to drop the rates. And then again, they start hiking the rates here in 89 and then have to drop the rates. And then we go into recession and then we dump down. They obviously, the recession hits and they just drop the rates as low as possible. I mean, it goes down 7.5 basis points, 7.5%. And then obviously start to raise rates again going into like 95, kind of flatlined here, raise them just a little bit more going into 2000, and then recession hits. So we see, obviously, whenever they raise rates, we see a recession coming, shortly afterwards. So here in 2000, we go into, the dot-com bubble crash. And then here again, they start raising rates starting in 2004, and they raise them until 2006. Stop raising rates, but don't lower them. And then, of course, we see 2008, the mortgage crisis, and obviously recession once again. And now here we are just flatlined at zero. This is a dead chart. If this was an asset, this would be a dead asset. So what does that tell you? One of two things is going to happen. This either just completely dies and becomes useless, valueless. It just goes to zero. Or it's going to break out of this downtrend because we see a series of a high, and then a lower high, lower high, lower high, lower high, lower high. So the next time we see this go up, one of two things is going to happen. It's going to be an even less of a dead cat bounce, which here, Powell got it back up to what, 2.4%. And then, again, he raised it to 2.4% from essentially zero, and then recession immediately afterwards, and then straight back down to zero as quick as possible because Powell's a little scared bitch. So yeah, obviously recession hits, oh God, everybody's mad at me because I'm crashing their stock prices. All the boomers are angry because I'm hurting their retirement. Do everything and anything and everything possible, to get us out of this. Just so happens, coincidentally, obviously, that this, coincides this random longest period ever without a recession, and then a tiny little rate hike and a crash randomly just coincides with this horrible pandemic. Thank God we took all these drastic measures to save us from the pandemic. That was the actual problem, I'm sure. Not this other stuff, not these other things, not these inevitable probability or possibility or likelihoods based on horrible policy that dates back 40 years. But I mean, I'm sure none of that had anything to do with it. So anyway, so here we are basically flatlined at this point in time. So where can we go from here on rates? Well, I mean, arguably they could go sideways for years at zero, sure. Or they could go up. But that's pretty much it. I mean, they can't go down. They can't go negative, yet. Not until they have in place something like, some kind of, Fed coin or something like that. But essentially, now let's look at how these things line up together and see what we could expect to happen in the future and what does that mean for the bond market, etc. So obviously I have them lined up now so we can see that for the most part, these are basically trading inverse to each other. This is going way down below zero. This is going way up. to extremely high rates. This is going way down. This is peaking. This is going way down. This is peaking. This is going way down. This is peaking. And then obviously this is going way down. This is peaking. But now what the difference is this is in a straight up downtrend. I mean, this is a dead asset right here. This is a crypto that everybody forgot about. This is BitConnect. Okay? This is just some trash asset that is literally just never worth anything again, until one day it is. This is, your Blockbuster or whatever. Here, we don't see that same trend taking place. Here, we see, a high. We see a slightly higher high. We see a slightly higher high. So we do see, that we're technically in an uptrend because we're putting in higher highs and higher lows, but we don't see it in the same way that we're seeing it on the Fed funds rate chart. So this one is more oscillating in a range, almost like a channel, basically. So now here we see what would potentially happen here is when this peaks out, it puts in a new high here, or I'm sorry, a new low here, a new high here. This one puts in a lower high here, and then it comes down and basically puts in that same low again. So this would tell us theoretically, if we basically just touched the inversion point right here, if we're going to continue this trend, and eventually we come back down here, if we're going to continue this trend and put in a higher low once again, we can't have the yield curve inversion take place. It can't take place because if it takes place, it'll be a lower low. So that will break the trend. In the same way that if the rates come up here, if the, Fed funds rate goes above 2.4, that will break the downtrend. And then what happens, everybody knows when you see a chart like this in a long downtrend, and then you take out that previous high right here, what happens? Well, it shoots straight up to the next high. And then what happens when it takes out that high? It shoots straight up to the next high and the next high. So what does that tell us? It tells us one of two things is going to happen. This is either going to flatline. This Fed funds rate is just going to flatline and they're just not going to touch it. And, it's up to the market, obviously, and them manipulating the market, like the short end of the curve, to keep it at zero. Or this thing's going to break out to the upside. And if this breaks out to the upside, that's going to change everything. Because if all of a sudden the short end of the curve, the interest rates on the short end of the curve start going up, what is that going to do? Well, if you're getting paid more interest on shorter term, people want to leave the long-term asset that they're in. Because you don't want to if somebody tells you, hey, I'll give you, 1% if you lock your money up for 30 years per year, or I'll give you, now something changes and you can get that same risk asset, so not just some junk bond, but still a government, treasury bond. And now you can get, let's say, for instance, 2% to lock it up for 1 year. Are you going to lock up any more money? Are you going to continue to lock money up for 30 years at 1%? When you're obviously getting destroyed by inflation, when you can take your money now and you can put it away for 1 year and you can make 2%? No, you're going to move everything back to the short end of the curve. So that's, essentially extrapolates the problem, because normally you would expect the curve to go up and to the right on the longer time frame, the longer duration. You would always expect a 1 year to pay less interest than a 10-year to pay less interest than a 30-year. So that's what we're looking at right here, and potentially a breakout and a change of, and keep in mind that leading up to 1980, this trend was 20, 30 years to the upside, and now it's been almost 40 years to the downside. So what does this tell us? It tells us that bonds have been in a bull market for 40 years and that there's not really anywhere else for them to go. So while I'm bullish on the American dollar, on USD in relation to other currencies, and what is a bond? Well, a bond is a promissory note for future dollars. Okay? So essentially, if you're bullish on the dollar, you should be bullish on bonds too, because all a bond is just a dollar that pays you, to lock it up for a little while. So theoretically, they should move together. So if the dollar is going to have this big spike to the upside, you would expect bonds also to have a big spike to the upside. But the yields already are, basically Fed fund rates like locked at zero. So what does that mean? It means that when this dollar spike happens to the upside, that bonds are probably going to spike to the upside too. So the yield's going to be absolutely terrible on them. So that, how does that correspond with like real life and what would be going on in the economy? It's basically telling us that people would be like afraid to have their money in other currencies or in other governments. So that tells me there's probably going to be some massive like instability, like craziness, governments toppling, like poverty, Great Depression scenario, rioting in the streets. Well, we're already seeing some signs of that, destabilizing of governments, of currencies, etc. So we're already seeing some signs of that. We're seeing some precursors to that, as well as like crazy policy decisions, in places like, Europe, Canada, etc. We've also already seen two countries that actually have currently got yield curve inversion taking place. Russia and I believe it's the Czech Republic both already have the 2 and 10 year inverted. So, and there's quite a few others, just trailing behind them. USA is still a ways away in comparison to the other list of like 15 countries before them. But the fact that we're starting to see it taking place, we have a world economy now. We don't have these just nations of economies. We have one gigantic economy with central components in it. Russia being one of them, China being one of them, USA, obviously like Europe, obviously, like depending how you break it all down, they're all integral parts of this economy. But the fact that we're already seeing yield curve inversion taking place tells us that likely to continue seeing this take place. So that's like basically the breakdown of it. So what does that tell me? It tells me it's probably not. The bond market is very smart. That's smart money, and it's much, much larger than all these other markets also. Much, much larger than the stock market, than real estate, etc. So what this tells me, what I theorize when I look at this, and keep in mind, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. I could be wrong. I will admit to something when I'm wrong. But, you have to admit that I perfectly nailed the inflation that's taking place right now. Okay? What did I say? Supply, constraint, inflation, bottlenecks in the system. I was saying it for months before it took place. Stock up on that inventory because everything's going to get more expensive short term. And then what's going to happen, which we're going to see very soon, we're already starting to see the signs now of that stagflation or stagnation of the economy or potentially deflation of the economy. Now, where are we seeing that at? Well, we're seeing it in ordering. Already we're seeing ordering falling off because we're going into the strongest season. The most ordering normally takes place leading into this, because everybody wants to get their products for the big sales towards the end of the year, Thanksgiving, Black Friday, Christmas, etc. Well, if you know that it's going to take you a month or multiple months to get your products, and you know that January and February are typically the slowest months of the year for like retail and whatnot, and that, we've pulled forward a lot of demand, and there's a lot of stuff you've ordered that still hasn't arrived yet, and it's only getting more expensive. What are you going to do? You're going to start tapering off those orders in anticipation that economies will slow. So then what happens? Well, the economies slow further because there's less ordering taking place. And then eventually the, supply chain bottlenecks are alleviated, and then everything goes back to normal, at least theoretically. Now, keep in mind, there's multiple types of inflation. Obviously, there's the monetary supply inflation, but there's also a bunch of other different types of inflation. There's push inflation, there's pull inflation, there's all different types of things that could be happening. Now, when I say that I think we're going into a deflationary environment, I'm talking about deflationary as in like asset prices, houses, stock market, cryptos, those things. Okay? I do not necessarily think that we're going to see deflation in goods and services. We're obviously running into problems where we're having problems getting goods and problems getting services. So like, are we going to see some prices come back down, alleviate? Sure. Do I think they're going to go back to where they were before? No, probably not. Some of them will probably never go back. I think a lot of things will be forever more expensive. Forever more expensive. But overall, I think that the prices of goods and services may continue to go up or stabilize or drop some. I think asset prices will take a big hit. Well, what happens when asset prices start going down? What happens when the housing market starts going down or crashing or consolidating for years and years and years? What happens in the stock market when we see a crash taking place or a downturn or whatever? What happens to bonds then? Well, let's just flip back to our chart here real quick. I think we're pretty much done with these, and let's see what we could expect to happen. So let's look at the TLT and look at it on the monthly here, and let's correspond up our time frame. What was this right here? That was March of 2020. What was that? Well, that was the stock market crash, obviously. So if we just flip over now and we look, obviously oil went to zero during that time frame, and went negative. What happened with the Dow? What happened with, everything? This is the same time, March 2020. So when these things crashed, bonds went parabolic because everybody flees to safety. So the money runs to the bonds and to cash out of assets to be safe, to get safe. So what does that mean for the big picture? Well, if we're going to have this big blow off top stock market crash or whatever that everybody's predicting or expecting or whatever, what does that mean? It means one last parabolic rally for bonds. Maybe to new highs, maybe just back to put in a lower high, maybe new highs, and we see massive divergence take place, as this was a buildup to that parabolic run. The bond market was telling us something from March of 2019. Who else was telling us something March of 2019? Your boy. Okay? The bond market was breaking out to new highs, going nuts. And then leading up to, this is basically December, the bond market had sold back off to the support, and then it started going parabolic. So the bond market knew there was about to be a massive stock market crash before the stock market knew there was about to be a massive stock market crash. So if this starts bursting to the upside, if we see 1 or 2 or 3 months of giant green candles to the upside, we can expect a huge crash in like stocks and cryptos and whatnot. But we'll see here, this was our candle from February. This was our candle from March. So February and March, we saw a big crash. What was the one right before it? Look at January though. January, this was already seeing strength right here in January, big strength. And then we see 3 white soldiers in a row, basically, massive indecision candle, topping candle, whatever. That's fine. But this already saw it coming. So what I'm looking out for is if this sells off right here, I think the stocks continue to rally, cryptos continue to rally. We see this parabolic bull market continue. But if we see in the monthly candle for the TLT or whatever random bond, treasury bond time frame you want to look at, that's fine. It doesn't matter. If we see a massive candle come in on TLT, if we see a pushback up to like 155 or 157 or something like that, I am going to expect that I'm going to completely de-risk, expecting that this will be a massive stock market crash. Potential divergence, bearish divergence, stock market crash, after which we see bonds peak, the dollar peak, and that's it. And that was our that was our big rally, our short squeeze, whatever you want to call it, for the dollar. But if we don't see that take place, I think the stock market keeps pushing higher. So that's what I'm paying attention to. Now, when this does crash, if bonds do crash, if these do capitulate, well, where do we put our money when bonds are crashing? Well, what happened here? This was the bottom of the stock market. And then the whole time bonds were selling off massively. What was going up? Well, stocks were going through the roof to new all-time highs. Cryptos were lagging way behind, but eventually cryptos were going to new all-time highs. They took months to get their chance, but they finally did. During this time, gold was going to new all-time highs. So we know gold, dollar, and the bonds were all, oh man, it gets so, there's so many correlations here. We know the bonds and gold were reaching all-time highs around the same time as people were afraid and running to security. Not afraid of inflation, but afraid of, what was going to happen, was things going to collapse, uncertainty, fear trade came into the bond market. As rates went to zero basically on bonds because people piled in on them. So now we know if this goes parabolic again, could gold go parabolic as well as people are afraid and there's craziness going on and the stock market's crashing? Probably. So this would tell us probably gold and bonds would go parabolic together. So alternatively, if this sells off and starts getting rejected, we would expect speculative assets like cryptos and the stock market to go parabolic to the upside, while basically gold and bonds get rejected. We see rates rise. We see, the yield curve less likely to invert, based on this chart. So there's a lot of moving parts going on here, and not all of them always trade together or, inverse of each other. So that's why it's so important to understand like the difference between all of them. And now let's just really quick flip over to the dollar and see where it lines up with all this as well, because I think this will be the final piece of the puzzle for a lot of people. So here we have March 2020, this massive indecision candle right here. And then again, we sell off and we put in our bottom in January of 2021. And then the dollar has been strong since then. So why is the dollar strong right here when bonds, why is the dollar strong basically while the stock market is strong? Well, this isn't actually the dollar compared to the stock market. The dollar is not doing well in comparison to speculative assets. It is doing well compared to other currencies. So that's the most important thing to pay attention to here is this dollar can go parabolic while other currencies are crashing, while asset prices are also going parabolic. So we could see a situation where the dollar and gold go parabolic. We could see a situation where the dollar and bonds go parabolic, where the dollar and speculative assets, stocks, cryptos, etc. go parabolic. We could see all these different situations. It's just a matter of what the catalyst is and why we're seeing that happen and what the association is between those. So that's the most important thing to pay attention to. There's so many narratives out there that you hear, well, they're printing a bunch of money, so the dollar's going to zero, so buy assets, buy gold, buy crypto, whatever. There's going to be a ton of inflation because they're printing dollars, so bonds are useless because you're getting a negative real yield. So do this, do that, do this, do that. But none of those things are for sure. I can't stand all the people that are talking in absolutes. This is 100% going to happen. It is for sure going to happen because we do not know what fiscal and monetary policy is going to happen. We don't know if someone's going to drop a nuclear warhead tomorrow. We don't know what the hell is going to happen. So for anyone to speak in certainties shows me that they're ignorant to the power of the actual market. What we do here is we look at the technicals, we look at what's likely to happen, we look for probabilities, we look for invalidation points, etc., overall trends, strength, weakness, correlation between these different charts, and then we make educated guesses as what's going to happen. And then we can look at fundamentals, we can look at technicals, we can look at all the different things that are going on here. We can look at, politics, we can look at the Federal Reserve, we do all those things. But in the end, no one knows what is going to happen. But the best thing to do is pay attention to not only the momentum and where it's shifting to, but pay attention to one, the smart money, which is the bond market, and two, let's pay attention to the yield curve. Because what is that yield curve doing? It's predicting, it's predictive, it's telling us what's going to happen in the future with almost absolute certainty. When we see that yield curve coming back down towards zero or inversion, when we see that yield curve inverting, we know we're about to go into recession. And what is recession? Well, that's stagflation, that's depression potentially, so we're already seeing two large, Czech Republic not large in the same way, but Russia obviously is a large player, a big player, and a large energy player in the world scope of things. So if we're already seeing yield curve inversion there, let's pay attention to what happens with China. Let's pay attention to what happens with Europe or Great Britain or whatever you want to, however you want to term some of these other key player economies. But I mean, China, Europe, and the USA, are big players. So they're what we want to really pay attention to as to what's potentially going to happen worldwide and the big scope of things. Because if I'm right about the supply chain bottlenecks coming out, if I'm right about the economy slowing down and then inflation picking up, and then all of a sudden now the Fed has to step in and raise the Fed funds rate going into a slowing economy. They're doing less asset purchases going into a slowing economy. What is that going to do? Well, we're going to start seeing those things sell off. And we know there's a direct correlation between the stock market falling and recessions. We know there's a direct correlation between interest rates rising and recessions. So if we're already going into a potential recession, and then all of a sudden the Fed is adding fuel to the fire towards a recession, that could cause like legitimate deflation to take place, like GDP issues. We already see China, printing negative GDP numbers. Is the USA right behind them? Are we technically probably already there? Arguably yes. So we got to be real careful at what's going on here and what these markets are telling us. But more likely than not, what we see in the bond market, what we see in the dollar is going to tell us what is likely to happen in the stock market. And it's probably going to give us, if history is accurate, we're probably going to have 1 month notice from the bond market before the stock market crashes. We're probably going to have a few months notice in the yield curve inversion before the recession hits. So we keep our eye on these different things and we can position ourselves accordingly. So even if we're not right about our thesis, our theories on the macro and the micro for that matter, we can still position ourselves accordingly and say, okay, we're wrong. The market is telling us something else. Now we respond to what the market is telling us instead of being, stubborn, ignorant people who just sit around and say, no, my theory's right and I'm sure of it. So I'm just going to stick to my guns. Because that's where a lot of intelligent people, fall to the wayside. Gold investors, for instance, they've been sticking to their thesis for, how many years, and how have they done compared to pretty much anything? Well, not good. But again, for me, safety, it's not an investment. So hopefully that's enough of a deep dive. If anybody has any questions or anything regarding that topic, obviously here on the channel or in the private group, please let me know. I would be glad to elaborate on any specific points. Hopefully I have given like a good enough overview of what's going on here. Obviously we could see the dollar turn around suddenly to the downside if, some of the other countries start to raise rates. As part of what's driving the U.S. bond market and the dollar to strengthen is the lack of rates or low rates in other countries. Because if you can get 1% to be in, England, or you can get, 2% to be in the United States, and you don't think that either one of them has, counterparty risk because you don't expect them to go away or anything or whatever, you're just going to go with the United States. Well, why wouldn't I? Get the extra percent, put it over here, So that tells me that as long as the United States has better yields than other countries, we're more likely to see money continue, moving this way. Also, when you start taking into account, obviously the U.S. is the, world reserve currency, etc. So even if everybody's going to leave the world reserve currency, which here's a quick little point too, I constantly see like British or European analysts and Canadian analysts talking about how the dollar is dead. They're printing it into oblivion. Everybody's going to flee the dollar. It's going to crash. It's going to go to 50. Like, are these people brain dead? They literally live in countries that are doing the same thing. Maybe not on the same scale, but when you take it into account to GDP, don't look at how much money they've created. Look at how much percentage of the money supply was created. Don't look at how much money was created. Look at how much money was created in relation to the GDP of the country that created it. Then come and talk to me about who's devaluing their currency. Then come and talk to me about the massive amounts of, additional money put into the system or currency put into the system. Because I'm pretty sure Canada and Europe look like shit, which is why we're seeing the DXY strengthen compared to them. Now, arguably, Canada has been looking better lately, but when you start looking at their socialist agenda, economy, wokeism, and whatnot, we're right back where we started, and they're looking like shit. So again, it's all relative. Keep everything in perspective. But for all these people calling, oh, this is going to crash, that's going to crash. Sure. One day it will crash. I agree. Definitely will. One day. Are you going to be alive? Most of these guys, probably not even going to be alive when that happens. Calling for, 3 months, 6 months, 2 years, done. Dollar will be gone. It'll be eradicated because the USA, all they do is consume. Sure. If you're going to be the world reserve currency, you have to consume because you have to export dollars, so you have to import goods. Therefore, it has to be profitable to import goods. If we had a bunch of production in our country that was cheaper than the production from other countries, we wouldn't be importing goods. Therefore, we wouldn't be exporting dollars. Therefore, there would be a dollar problem in the system. Therefore, the dollar would go up in value in relation to other currencies. Therefore, it would cause extreme stress on the global markets. So when we became the world reserve currency, we had to intentionally devalue our dollar and export our production in order to, export production and dollars in order to import goods, in order to supply those dollars to the people who need them to settle in US dollars. So it's all part of the process. I mean, I'm not saying it's good. I'm not saying it's fair, but that's how it works. It's literally how it fucking works. So, these people don't understand it, but it is what it is. There's a lot of stuff they don't understand. Most people are really good at understanding one itty bitty little thing, okay? And then they get so micro focused on that little itty bitty thing that they're just so sure of it that they lose sight of everything else. The forest for the trees analogy.